All right, let's jump right in. At the very core of our entire economy, there's this constant flow of capital, a system built on one thing: lending. It's really the engine that powers everything, from a tiny startup to massive infrastructure projects. But this whole system, it really just rests on a single fundamental idea: a promise to pay it back.
Every single loan, no matter how big or small, starts out as a journey that's built on that promise. But for the banks and financial institutions that are fueling our economy, it's also about managing risk. Things like property valuations, for example, are a huge part of their risk control framework, a system designed to make sure that the entire journey for every single loan stays as smooth and stable as possible.
And that question, that right there is the absolute essence of credit risk. It's the chance that a borrower just won't, or maybe can't, repay their debt. And honestly, managing this risk is one of the most critical jobs in all of finance. So today, we're going to follow a loan's entire life, from its perfectly healthy start to its potential and sometimes hazardous decline.
So let's start at the very beginning. Before a single cent is ever lent out, every loan applicant has to go through a pretty thorough health check. And this is what we call the rating process.
Think of this as a financial scorecard. A bank can't just lend money based on a gut feeling, right? It has to systematically and carefully assess the borrower's ability to repay. This initial rating pretty much determines everything that comes next.
Now, to get a really complete picture of the risk, banks usually take a two-pronged approach. They develop their own, often very sophisticated, internal models to score borrowers, but they also lean on external ratings from specialized agencies like Moody's or S&P. Combining both of these inputs is absolutely crucial for an accurate assessment.
Ultimately, all these different ratings and scores, they're all designed to calculate one key metric: the probability of default, or just PD. This single percentage is really the cornerstone of credit risk. It answers that one fundamental question: what are the odds this borrower will fail to meet their obligations sometime in the next 12 months?
But here's where it gets interesting. Banks actually need to look at this risk through two totally different lenses. The point in time, or PTPD, looks at risk right now, reflecting today's economy. That's super important for accounting. But then you have the through the cycle, or TDCPD, which takes a much longer view, averaging the risk over an entire business cycle. This is the one regulators care about for ensuring the bank's long-term stability.
So, what happens when a borrower who started out perfectly healthy begins to show signs of financial trouble? This is where the loan's journey can take a pretty dangerous turn into some very troubled waters.
The word default, it isn't just a vague idea of being late on a payment. In the world of banking regulation, it's a very specific status with clear, hard-coded triggers. It's the official alarm bell that a loan is in serious, serious trouble.
So what flips that switch? Well, a loan moves through stages. A healthy one is stage 1. If risk goes up, it hits stage 2. But to get to stage 3, or default, it's usually one of two things. The first is easy and quantitative. You've missed payments for 90 days straight. The second one is more of a judgment call. It's called unlikely to pay, where the bank has clear evidence you're in deep financial trouble even before you've hit that 90-day mark.
Of course, it's not always so dramatic. Banks have to be really careful to tell the difference between genuine financial distress and what they call a technical default. This could be something as simple as an IT system hiccup or a payment processing delay. Spotting these false alarms is a huge part of the process.
Now, before a loan officially defaults, banks have a tool they can use to try and nurse it back to health: forbearance. You can think of it like a treatment plan. The bank might do things like temporarily lower the interest rate, extend the loan term, or even offer a payment holiday, just to give a struggling borrower some breathing room.
But this kind of help comes with some pretty strict conditions. A loan that gets forbearance is flagged, and it enters a probation period. The borrower has to show 2 full years of perfect behavior, making every payment on time, before that flag can finally be lifted. It is a long road to prove you're financially healthy again.
Okay, so far we've focused a lot on the borrower's promise. But what about the bank's insurance policy? This is where collateral comes into play. It's the safety net that protects the lender if that promise is broken.
The idea is really simple. If the borrower can't pay back the loan with cash, the bank can seize and sell an asset to get its money back. This whole process, called credit risk mitigation, is fundamental to lending because it directly reduces the amount of capital a bank has to hold against that loan.
So what kind of assets do banks accept as security? Well, it can be financial stuff, like cash or government bonds, although the value of those bonds might get a little haircut to account for price swings. The most common one, of course, is real estate. And finally, you've got guarantees, where another person or company co-signs the promise to pay.
Now, when it comes to property, different places have unique ways of valuing it. In Germany, for instance, they use a fascinating concept called Beleihungswert. This isn't the price of the property on today's hot market, no. Instead, it's a deliberately conservative, long-term value designed to hold up even if the market goes down. This prudence is a big reason why their banking system has been so stable.
And this leads to a really crucial point. For a loan to be included in Germany's super secure covered bonds, called Pfandbrief, the loan amount can't be more than 60% of this already conservative lending value. Just think about that. It creates this enormous safety buffer for both the lender and the person who buys the bond.
So this two-layered conservative approach, a cautious valuation plus a low loan-to-value ratio, that is precisely what makes German Pfandbriefe some of the safest financial instruments on the planet. The whole system is just built on prudence.
And now we've arrived at the final stage of our journey. What happens when, despite all the ratings and the collateral, a loan officially defaults and becomes a non-performing loan, or an NPL?
Once a loan goes bad, the bank basically has three main plays. First, it can hold the loan and try a workout, which means working with the borrower to recover as much money as possible. Second, it can sell the loan on the market, usually at a pretty steep discount, to a company that specializes in debt collection. Or, as a last resort, it can just write off the loan and take the hit to its profits.
Now, regulators don't let banks just sit on these bad loans forever. The European Central Bank, for example, uses a system called calendar provisioning. It puts banks on a strict timeline. An unsecured bad loan has to be fully covered within 2 years. Even loans secured by real estate have a 9-year deadline. This pressure forces banks to actively manage and get rid of their bad loans. So as we zoom out, you can see that this entire life cycle, from that initial rating all the way to the final workout, it isn't just left to chance. It's governed by this complex and really detailed rulebook set by authorities like the European Banking Authority. The whole goal is just to make sure that the failure of a few loans doesn't threaten the stability of the entire financial system.
And that leaves us with the big question, right? Every rule, every buffer, every single check in this process is designed to build a safer financial world. But does this incredibly intricate web of regulation create the ultimate shield, or does its sheer complexity end up stifling the very lending that our economy needs to grow? That is a constant and fascinating balancing act at the very heart of modern banking.